Good morning, ladies and gentlemen. If you could take your seats, please. Thanks very much. My name's Mark Stephen. I'm going to be chairing today's event. Welcome to our 9th Annual Financial Technology Summit, which is the launch event of the Scotland Fintech Festival. Now, as you're only too aware, much more so than I am probably, the pandemic accelerated the move towards digital, which is obviously a very good upside, hurrah. The downside is you've got a bunch of customers that don't want to wait, they don't like faff, and they have seemingly limitless options. So what do you do about those two things? Well, that's what we're here to discuss today. Before we actually get to that, however, I have to run through some housekeeping, so please bear with me. Please turn all mobile phones to silent. If a phone rings at any stage during a presentation, you have to stand up and do a little dance. It's very embarrassing. Happened to me. Toilets, as you know, are located on level 2, the floor above. There's no fire alarm test scheduled today, so if it goes off, it is for real. Please take it seriously. Make your way to the nearest fire doors and out to the assembly point on Holyrood Gate. Digit staff will be on hand to direct you. All catering will take place in the Stratosphere upstairs behind the registration desk, and if you're using the venue car park, you can get a reduced rate of £6 by visiting the conference registration desk and parting with hard cash. Take the time, if you can, just to talk to people. I can't tell you how nice it is to actually see. We've obviously run these events since the raising of restrictions from lockdown, but this is the first event, personally, I don't know how you feel about it, that I have felt it's back up to the same level of energy. You know, people have got that confidence again. It's nice to actually see it. Thank you very much to all our sponsors and exhibitors. We've got a great range of solution providers from across the supply chain in the exhibition area. Take the time to visit them. If you are tweeting at all today, if you can include the hashtag #FTScot, that will be useful. It allows us to follow any conversations that are going on. Very briefly, I'll point out a couple of forthcoming events. The Financial Technology Awards are on the 6th of October in the Sheraton Grand, Edinburgh. This is the closing event. This is the opening event today, but that's the closing event of the Scotland Fintech Festival. If you haven't booked for this yet, it's not too late. There are still table places and a few limited sponsorship opportunities are available for the awards. Digital transformation takes place on the 12th of October here in Dynamic Earth, and Digit Expo is on the 10th of November, Edinburgh, in the EICC. Details on how to book for all of those can be found at www.digit.fyi. That's the housekeeping. Now, we're delighted to welcome Nicola Anderson, who's the Chief Executive Officer of Fintech Scotland, just to say a few words at this opening event. So, Nicola.
Good morning. Good morning. Thank you very much, Mark. It's an absolute pleasure to be here. And indeed, I was reflecting with someone earlier on. Last year when we stepped in and we all got our badges, there were little codes to say green, amber, red, giving us an indication of how comfortable we are coming out of COVID. And today, there's none of that. So absolutely, that energy is back, and we're really looking forward to the session. So we kick off the Fintech Scotland Festival today. It's an absolute pleasure to do that. Thank you to the Digit team, to Ray, and to all of those behind the scenes organising today. It's an absolutely fantastic agenda, and it sets us off on course for a fabulous 3 weeks where we get an opportunity to really think about the opportunity fintech innovation presents for us here in Scotland, for the financial services sector, for our developing digital economy, and for our customers, for consumers, for businesses, those people who really need that at the moment. Whilst there's no doubt we're in a period of reflection, we're also in a period of celebration, and we're looking forward to celebrating fintech innovation over the next 3 weeks with you all. The events will help us explore the art of the possible. They'll give us space to think about fintech innovation, to be curious, to think about how technology will give us an opportunity for the future, and to want to shape those new solutions that will give us the necessary and equip us necessarily for the future. We start today with that agenda and that tone, and I think you'll agree, as Mark said, the tone for today's agenda really helps us to focus on the opportunities ahead. Across the rest of the festival, there's more on those topics. We'll also consider the likes of Web3, we'll think about crypto, we'll look at research and innovation, we'll lean into open finance, we'll think about reg tech, my favourite, as anybody who knows me. We'll think about space tech and many, many more things in how fintech innovation helps us do all of that. The one thing I love about fintech, and it's important, I think, to say, is actually the people. The diversity of contribution is what helps us really advance the opportunity for the future. Sitting in our audience today, the range and diversity of contributors staggers me constantly, and it really helps to make our cluster here in Scotland the one that we want. Many voices contributing to what we need the future to be. So thank you to all of those innovators, financial services institutions, professional services organisations, consumer groups, academics, students, policymakers, government officials, the media, all of our friends who are leaning in to help us with this opportunity. So I'm not going to delay proceedings too long. I'm really keen to get things kicked off and get us started on the festival so that we can celebrate fintech innovation. But before I do that, let me tell you why we're celebrating here in Scotland. There are a number of reasons. The number of fintech SMEs has grown again. Year on year, we are seeing increases, and we stand today in this auditorium with over 200 fintech SMEs in the Fintech Scotland community. And that's significant. 5 years ago, we had 28. So it's a really great moment to pause, be thankful, and to celebrate that success. Pipeline innovation continues to grow. We are seeing more investment into fintech businesses here in Scotland. Staggeringly, we've had £1.2 billion worth of investment this year in Scotland, and we have seen unicorns rise in Scotland. We are really proud of that, and we want more for the future, please. So let's keep that going. We are seeing more partnerships between the big and the small, and there are more people leaning into that way of that model. And that's really critical as we think about the focus for responsible innovation, and we're really excited about that. And most of all, we published our research and innovation roadmap in March this year. That was a significant contribution from all of you in the room, industry representatives, a business-led piece of work that allows us all to think about what we want to see innovation advance for the future. So it sets us up really strongly for our strategy as we look towards 2023 and 2024. We reached a significant milestone here in Scotland this year, and we publicised it over the last few weeks. As a cluster of fintech innovations here in Scotland, which is all of you, our cluster here, connected with the UK, connected internationally, we achieved a cluster accreditation of Silver Excellence, and that was no mean feat. This accreditation was awarded by the European Commission's body for assessing cluster excellence. We are the first fintech cluster in Europe to achieve this, and we are really proud, because we are really proud of the contributions and the commitment that all of you offer to help us strive towards fintech success. So thank you for that. So as we look towards the future, it'll come as no surprise to anybody that knows me that we're now striving for gold. We have 2 years to help us get there, and thank you for your continued commitment in helping us to do that. I know we can achieve it. We will use our R&I roadmap, our research and innovation roadmap, to help us set our agenda. We will listen and we will think about the contributions that we all want to make, and we will advance those initiatives and activities being really action-orientated to drive that change. We will continue to have diversity of contribution, which is really important, and we will celebrate those fintech innovations who are very purpose-driven, driving a culture of intent here in Scotland to help us achieve better outcomes for people, better outcomes for the climate, and better outcomes for all across society. So thank you is my final note. In this reflective and notable period in time, thank you for all your support, your contribution, your commitment, and your active participation in helping us achieve fintech excellence success. We cannot do it without you, and we are looking forward to more of the same. I'm really looking forward to seeing many of you over the next 3 weeks. Please come and say hello. Tell us more about what you're doing. We'd love to hear that. We'll celebrate even more at the end on the 6th of October, as Mark said, with the awards. But throughout the course of today, we'll lean into those important topics that really will help us focus on action for the future. Thank you. Thank you very much. Thanks.
Thank you. Thank you very much, Nicola, for that scene setter. Nicola referenced the old traffic light lanyard system. Anybody remember them? Just as we were coming out of lockdown, a very simple but very clever idea that people felt different ways. So if you chose a red lanyard, that says, look, I still want to socially distance, please, don't touch. Amber was a bit more ambivalent. That was like sort of fist bumps and elbows and things like that. And green was basically the exchange of bodily fluids, according to some people. Anyway, our first speaker in this first session in the morning is Jason Maude, who's Chief Technology Advocate from Starling Bank. And he's going to be talking us through what they're doing, why they're doing it, and where they think they're heading. So, Jason, over to you.
Thank you very much. Good morning, everybody. I wanted to take this opportunity at the start of this conference, and indeed the start of this festival, to talk about fintech and where it has come from and where it is going, focusing on both the customers who use and depend on our services and the technology, and how the technology works and how the technology enables what we're doing. And hopefully, I will also be able to do a little bit of crystal ball gazing and predict where we are going in the future, or more precisely, what we are going to need as we go into the future. So I'll begin my remarks by talking about where we have come from. Ancient Sumeria created the concept of finance. Skip on a bit. Unfortunately, we don't have time to go through the entire history of finance, but it starts a long, long time ago. Obviously, technology, specifically software technology, which is the tech of fintech, has been around as a commercial concern with us for 50, 60 years. But the real coming together of these two concepts into fintech, what we know of as fintech today, really started in 2007. And there were two events that happened in 2007 that I want to highlight and reference. The first one was in June 2007, which was the launch of the first iPhone. Now, this itself was in some ways, an evolution, not a revolution. We had access to the internet for a reasonable amount of time before that, and even portable access through laptops. But what the iPhone really did is it enabled access to the internet, access to the vast amounts of data that we have available through the palm of your hand. You really could put it in your pocket and, everyone had one available and ready. And that instant access to data, that instant access to be able to send and receive messages and transactions, importantly for us, suddenly became possible, a reality, to the extent that now it is generally accepted and anticipated that most people will have one of these in their pocket. The other event happened a little bit later on in September 2007, which is I started working out of university. No, which happened 1 week after I started working in financial software, just as I came out of university, which is the first run on the bank in the United Kingdom for quite some time, when Northern Rock collapsed after people started distrusting that the bank could pay them back their deposits, and they all queued up to take their deposits out at once. Prior to that, run on the bank, when you said that phrase, conjured images up of that scene from Mary Poppins, the 1960s version. And then it started conjuring up not only that image, but the famous shot of people queuing up outside Northern Rock branches trying to retrieve their money. This event obviously was the precursor in the UK, the first sort of real public acknowledgement that something was very wrong with the finance system. Something had gone catastrophically wrong, and indeed that rippled out into the financial crisis of the late aughts. These two events, the iPhone and the collapse of Northern Rock, both highlighted the need for change within the financial industry. The first one highlighted the fact that technology and thus consumer preferences were moving on, and that we, as the finance industry, needed to move with the times. We needed to advance and give customers more than we were giving them before. The second one, Northern Rock, highlighted the need for more resilience, more ability to serve the customer and continuing to serve the customer, even in the face of disaster, and rather than collapsing like a jelly when something hit us. So, the need for change and the need for resilience, both highlighted. And Fintech came along, and I think where Fintech succeeds is where it manages to answer both of these challenges. So how has Fintech changed the customer experience? Well, in one respect, a very easy, obvious to see respect, what's happened is that we have given the customers more choice over how their finances are controlled and managed, more choice over different parts of sending and receiving transactions, more choices in terms of banking, in terms of pensions, and so on and so on. And this choice obviously helps raise the bar across the market and make things that were first nice-to-haves into essentials. I always have a bit of a smile and a chuckle whenever I see one of the big high street banks come out and say, you can now freeze your card. You can now split your account up into different spaces. You can now get instant notifications on your phone of your spending. And I'm thinking, yes, and why have you done that? Because Starling and other challenger banks put those features out there and then forced you to up your game and do something better. And this, I think, is true across the whole fintech industry. We are pushing the bar upwards and making the whole of the finance industry step forward and actually consider customer needs more greatly and challenge each other to go further in serving customers. More fundamentally, however, I think what has really changed is the attitude towards financial data. In the past, I remember a time just about where financial data was something that was the property of the bank. The bank had your financial data, and it may deign to let you see some of it, maybe. But what we have done in fintech is we have really opened that data up. A huge number of the innovations that we have seen have been to do with allowing customers to see what is going on with their finances, to help them make informed decisions about what is going on with their finances from their data, to really look at their data, examine it, see it in many different lights, not just the instantaneous what transactions are going through, but also taking a longer-term view, a more aggregated view of their finances and seeing what is going on there. This data and the way we treat data is incredibly important. It's as important, I would say, as the finances themselves. The ability to access data is required to promote trust nowadays, and trust is incredibly important for the financial industry. Many people like to compare data to oil, which is, the idea being that you can extract value from data. But I prefer to compare data to money. As a bank, Starling Bank can benefit from its customers' deposits in aggregate, right? We can take those deposits in aggregate and we can lend them out, and we can make money from lending out those deposits. But we always have to remember that we are holding our customers' money in trust. And if a customer comes to us and says, "We want our money back, please," then we have to give them their money back, because it is their money. And the same applies to data. We can benefit from a customer's data in aggregate, your customer's data in aggregate. But if a customer comes to us and says, "We would like our data, please. We want our financial data that you hold on us," we have to be able to give it to them. We have to be able to give it to them as freely and easily as we can give them access to their money. We have to be able to make sure that they can take that data, they can easily transfer that data where they like, where they authorize. So we have to understand that the data belongs to the customer, it doesn't belong to us. Same thing with their money. The other thing that we have done for customers is to go back and answer the second of the two challenges that we find from 2007, is resilience. We've had to answer this resilience challenge. How do we make sure that we create resilient services that are always there when customers need them and that don't go down and out and fade away? So, for much of the finance industry, these two challenges posed in 2007 have to be held in balance. On the one hand, they have the convenience, the new features, the access to data, all of the things that the creation of the iPhone and the subsequent revolution there has generated. And on the other hand, they have the resilience question, and resilience, security, reliability, and so on. And they hold these two things in balance with one another. And all their conversation is about finding the right balance. And the problem with this is that if you hold these two things in balance, it means that you can't bring one up without moving the other one down. You can provide more convenience, they think, but only at the cost of security and reliability and resilience. And you can provide more resilience, reliability and security, but only by locking things down and going slow and not providing anything. So their question is all about finding the right balance. One of the great things I think about Starling Bank is we have rejected that idea of balance. We have said, no, we are not going to put these two things on a scale. We are going to create a system that enables both of them to be achieved at the same time and makes them mutually reinforcing. How do we do that? Well, this is where we come on to the tech part of fintech. Tech behind the scenes enables us to eliminate this balance and have both of these things as self-reinforcing. First up, I have to give credit to the cloud. I think that without the cloud, we wouldn't be here in this room today. This conference wouldn't be happening without the existence of the cloud, because I think the cloud has really been there to enable fintech, because it has enabled us to answer both of these questions at the same time, both the question of how do we deliver more for customers and how are we more resilient. The cloud has allowed us to both go out there, try things out without having to invest in a whole set of physical infrastructure, a whole server for ourselves. We can go and try things, try pieces of software, try running things on the cloud. And then it's also promoted resilience, because once you don't have to worry about the physical server anymore, you don't have to create a backup site somewhere else and DR tests and all of that sort of thing. You can trust that if a physical server goes out at the server farm, that you will be transferred over to another server and that you will notice a blip if that at most. So you've got this, this great technology which enables you to answer these questions, both of these questions, these challenges at the same time. But that's not enough. You can't just have that. You also need to take advantage of the benefits provided by the cloud. And this is where I think Fintech is also doing a great job. At Starling, the way we take advantage of these benefits simultaneously and how we break the balance and have the two challenges answered in a mutually reinforcing way is we create systems internally that are skeptical. Now, let me go into a bit about what I mean by that. What I mean by that is we have lots of internal systems running, doing different things, providing different services in the bank, maintaining a running track of the balances of the customers, showing the customers the history of what they've spent their money on, controlling customers' card payments, direct debits, and so on and so on. Different systems in the bank doing different things. And these systems are mistrustful. They are skeptical. They check and recheck everything that is done. They make sure that other bits of the software landscape, are in the correct place. They don't just assume that if they've sent an instruction that has been followed, they recheck to see if the instruction has been followed. They don't just assume that any instruction they have been sent is a new instruction. They check to see whether that instruction has been sent before. They do all of this skeptical checking. And the reason they do this skeptical checking is so that if we can assume, as the humans running Starling, that if something goes down, not if something goes down, when something goes down, when a server falls over, when a third-party supplier makes a mistake and sends us the same instruction twice, when we make a mistake, we put out code that doesn't work, we know that the system will catch itself up. We know that the system will stop what it's doing and check, see whether it has performed an instruction correctly, and then make sure that it has performed that instruction, redo it. So, with this skepticism, putting this skepticism into the systems themselves, you create resilience, but you also create the ability to move fast like a tech company. Because you know that if you move fast and break things, as the tech company motto goes, that what's going to happen is that the system is going to be there to be resilient on your behalf and stop mistakes happening and stop them affecting customers. Resilience is not about not making mistakes. Obviously, that's great if you don't make mistakes in the first place. But resilience is about the question of when you make mistakes, because everybody inevitably does at some point, how can you limit the impact? And having skepticism built into your software systems themselves is, I think, the way to go, because that is much faster. Software systems are much faster to correct themselves than human manual intervention will be. Right, I've talked a lot about where we're going, where we've been, the direction of where we've been, because that is easier to talk about because it is known, it is in the past. So now it's time to do a little bit of crystal ball gazing and look into the future. As a wise man once said, predictions are very difficult, especially about the future. But hopefully we can extrapolate some of the trends. And what I want to talk about specifically is three types of resilience that we are going to have to look out for as Fintech as we go out into the future. And my prediction is that if people get these three types of resilience right, that they will be able to continue to answer those two challenges from 2007 and be successful into the future. The first one of those is legacy tech resilience. So at the moment, everything we're doing is very new, very greenfield, fantastic, but if you want it to continue going on into the future, it's going to have to be built on and iterated over and so on. And there is always the danger that in 20 years' time, you will find yourself in exactly the same position that big banks are in now. There will be a COBOL server sitting in the basement somewhere, and only Steve knows how to maintain it, but Steve is retiring next year, and you have to back up a truck of gold to his house every day to make him come in and maintain the server. Don't get stuck in that position. Constantly maintain your code, constantly update your software so that you don't get stuck in the legacy tech trap and you are legacy tech resilient. Second type of resilience is network resilience. Gone are the days where the entire financial supply chain was run by one big institution. Now it is run by a whole host of institutions, a whole host of companies and organizations, many of whom are in this room. Ultimately, what the customer cares about is, will their payment go through from one end to the other? That's what they care about. And if it's going through lots of different points on the chain, and if one point in the chain breaks, then that resilience of the entire network suffers. And when that happens, because inevitably it will, what needs to happen is that the two sides of the chain need to work together to fix it. Ultimately, what you don't want to hear when you pick up the phone and say there's a problem is, everything looks fine on our end, click. That is not resilient. That is not network resilience. Even if the problem is at the other end, helping the other side to solve the problem ensures that the network is resilient and that you are doing your job in taking things forward and ensuring that the customer's payment end-to-end works. And ultimately, you're not putting the burden on the customer to do the work for you. And finally, resilience of our businesses. Fintech came out of the crisis in 2007, which was in part caused by the avarice, the greed of the banking industry being unchecked. And as a result of that, I notice sometimes there is a reticence among people in fintech to talk about how we make money. But we have to make money in order to be good businesses. Venture capital isn't there forever, and the idea that there will always be another funding round is going to be severely tested in the oncoming storm of the recession. So we have to make sure that we can be sustainable as businesses. We have a plan to make money, not just to grow and grow infinitely, but to actually make money so that we can continue to exist and continue to serve our customers. But if we follow and try and have these three types of resilience in our businesses, then I think that we will all be able to weather the oncoming storm, and we will all be able to grow, develop, and continue to serve our customers long into the future. Thank you very much.
I have a text in from Steve saying he disagrees with everything Jason says. And keep sending the gold. If you've never read it, have a look at John Lanchester's book, Capital. It took me 3 goes to read it because I kept on throwing it into the corner of the room and shouting at how stupid the banks had been. It's an astonishing piece of work. It's very well, from a historical standpoint, very well worth your time actually sort of going through it. It may be nobody in this room. Did anybody chain up a white mountain bike to the railings at the front of the building? If so, can you go and move it just now before some silly bugger tries to defuse it? It's as if it's not in here, it doesn't really matter, but somebody's done it and it's making them nervous. Okay. Our next speaker is Caroline Murphree, Managing Director of Investment, Retirement and Savings at Moneybox, looking at how technology can improve financial resilience. So, Caroline, over to you.
I promise I'm talking about a different type of resilience than we heard a lot about in the last one. So, resilience. An ability to recover from or adjust easily to misfortune or change. And obviously, when we talk about financial resilience from a consumer perspective, we're therefore talking about the ability to recover from or adjust to changes in one's income or assets. So what does financial resilience look like in the UK? In 2014, a third of UK households would not have been able to last a week on their savings. In 2020, research showed that average UK household resilience was about 24 days, still less than a month. 2 years later, after 2 years of a COVID pandemic and also increasing costs of living, that number's down to 19 days. It's down by 20%. What the cost of living crisis is really showing us, apologies, I thought I had one more click there, is that as a society, we need to take financial resilience a lot more seriously. When we talk about financial resilience, we often talk about this kind of data, savings in rainy day funds. But at Moneybox, we really think that resilience is about a much longer term approach to people's personal finances and their relationship with money. You know, rainy day funds are a critical part of that plan, but people really need to have a much longer term approach to planning for changes in their income and assets in the short, medium, and long term. And as Jason somewhat touched on, you know, we're not actually that good at predicting the future. I don't think anyone knew that, you know, COVID was coming, or that we would have a war in Europe, and that all these things in supply chains would affect people's ability to afford day-to-day goods. Now, part of our challenge in building greater financial resilience is that most of us never received any financial education at school about how to manage our money or to plan for the future. And as a result, many people don't start actually building good financial habits that will help them to achieve their goals early enough in life. At the moment, only about 24% of UK adults regularly make a budget to help them manage their money. And you need both financial knowledge and understanding how things work, and also financial discipline, by which I mean a plan, to build that financial resilience. By discipline, I also mean that it needs to be something that we think about regularly. It may just be an hour a week where you actually sit down and look at what you've spent, what's coming in, contribute into your pension, or put money in an ISA or into your home buying fund. And the longer that we neglect this longer-term financial planning, the more difficult it actually becomes to manage its impact. So if, HMRC is launching their midlife MOT campaign, but if someone is looking at their finances in their 40s, they've potentially already missed 20 years of contributing into a pension or benefiting from compounding and investing by having their money sitting in a bank account. Now, one very important example to me, as someone who thinks about retirement a lot, sorry, pensions, yes, is that the legacy of poor financial education can really be seen in the move from defined benefit to defined contribution schemes over recent history. So, you know, with defined benefit schemes, they tend to be more heavily funded by employers. The average total contribution per member tends to be between 20 and 25% of pensionable salary. The responsibility for managing the funds is actually sitting with the schemes and the employers rather than with the individual. And that means, you know, that the scheme is responsible for delivering a certain level of benefit to the end scheme member in retirement. But the individual scheme member doesn't actually need to get terribly involved in how those funds are managed. Now, with the shift to the defined contribution world, we see a really significant change. So first of all, there are many things about auto-enrollment that I think have driven a lot of benefit. More people have pensions now than did in the past, and that is fantastic. But those funds are now much more funded by the individual. The average total contribution is averaging between 5 and 8% per member, which is just a fraction of what's going into DB schemes. And critically, the responsibility for managing those assets has been passed to the individual, with no accompanying context, support, or financial education about what it means to plan for the long term. And this is having some really profound consequences. So at the moment, 51% of auto-enrolled employees believe that the current contribution rate is the recommended savings level for retirement. 80% of them do not know that they are not saving enough money. And just this week, Pensions Minister Guy Opperman has told MPs that 12 million people, or almost 40% of the UK working age population, is not saving enough. In addition, Moneybox research conducted last month showed that about 2/3 of UK consumers do not know how much they need to save for their ideal retirement, and they also do not know how much they currently have. Giving consumers more control, as Jason mentioned, has some fantastic upsides and benefits, right? They can choose where and how they invest. They can also, choose how much they're paying for some of these services, etc. But giving all of this control to consumers without also helping them to understand the implications or to help them think about building their long-term plans is also leaving a lot of people feeling really overwhelmed and less confident about what to do and also where they're actually going to end up. And this lack of understanding is going to have a massive impact on people's incomes later in life, which we are also going to feel much more broadly across society. The wealth management industry has had a number of historic problems. I won't really belabor this point. I think those are well known. But a lot of these problems are representative, I think, of problems in other parts of financial services, and they have a massive impact on overall financial resilience for the UK consumer. So, first of all, it was not inclusive. You had to have a certain amount of wealth or scale in other contexts to be able to participate. High fees made it very inaccessible and unaffordable for many, many people. It was built on face-to-face relationships, which limited scale and reach. And as also was previously mentioned, it was not particularly transparent. Financial advisors, stockbrokers, and other specialists serve as knowledge gatekeepers and sort of manage a lot of the complexity of the system on behalf of their customers. And so while the system worked for those inside of it, all of these barriers to engagement really contributed to low levels of financial resilience for people who are outside and who are often keeping money in their savings accounts or, in some cases, in property, but not benefiting from the growth that comes from investing. So, Fintech has obviously tried to break down a lot of these key barriers to really enable people to benefit from many, many more ways of accessing financial services. And we believe this is still going to help drive greater resilience while keeping customer needs at the heart of what we do. So, first of all, accessibility. Technology can really make information and services a lot more accessible and inclusive. Obviously, wealth building platforms like Moneybox use technology to scale and therefore serve a very large customer base, which allows us to start serving customers at much lower asset levels and make it much more available to people. Secondly, providing people with tools and information like calculators, projections, etc., can really democratize service. If you can self-serve, you get the same level of service, no matter who you are. And fundamentally, many groups that have traditionally been excluded by the industry actually feel that technology is more neutral. It's more unbiased than working with a human. The second point, obviously, is around affordability. So, as I'm sure many people in this room know, technology can really be used to reduce the cost to serve through centralization, automation, removing overheads, etc., and therefore to provide services to consumers at a lower cost, and therefore enabling more people to engage. Most digital wealth services are available to consumers for less than 1%, whereas you might pay 2 to 3% for a human IFA. Embedded finance companies, which we will hear more about in the next talk, are really driving scale and process efficiency that allows us to reduce costs both for businesses and for consumers and to create our own sustainability as businesses to continue providing services. Things like fractionalization of share trading actually are now allowing customers to participate in the growth of exciting companies, even if the quoted share price would otherwise be prohibitive. Automation, and I've just described some of the sort of back office automation that can happen, but the other thing is we can use technology to actually automate good behaviors, good savings behaviors for customers. So coming back to the point about habits and building good sort of financial disciplines, we can make some of these good savings behaviors less painful and also help deliver really good outcomes. So, there are many apps and tools that help customers through open banking, look to cut unnecessary expenses or find and switch to lower cost providers for utilities, etc. We can also use lots of behavioral nudging to support consistent positive savings behaviors that suit the individual. So weekly deposits, roundups, payday saving, etc. Just little ways that people can start putting money aside almost unconsciously, but that build towards a longer-term savings pot. Another one obviously close to my heart, pension search tools are helping people track down their old pension pots, and so they don't lose track of money that they've actually already saved. And obviously we hope more will come on this with the dashboards over the coming years. Engagement and education is the other really big one, and as was already discussed a bit, the fact that people are now able to have so much financial information in their pockets, it also radically opens up opportunities for engagement and education, and for us to have conversations with customers at scale that can still be interactive across multiple channels and multiple formats. So, people can research mortgages and on comparison sites on their way home on bus. They can read blogs about investing in crypto. They can watch a TikTok video about how to save for your next holiday. And this also opens up lots of opportunities for proliferations of information. But I think we, as fintech companies and as a service or an industry more generally, also really have an opportunity to make sure that we're helping customers with the right information. Gamification can help make savings goals feel much more tangible and attainable. And we can also increasingly use analytics to discover how to deliver the right content to the right user in the right content and format to drive the best engagement from them. At the moment, we've just recently launched our Feel Pension Positive campaign at Moneybox, which is really about using multiple formats and multiple channels to try to help our customers learn more about their pensions and feel really confident in the actions that they're taking with them, whether they hold those pensions with Moneybox or anywhere else, right? We think that this is really important for people to understand. And finally, transparency. Sort of gone are the days of monthly or annual statements, as we heard about earlier. With technology, consumers can see their data in real time. They can see how much money they have, how it's working for them, what they're paying for those services. Open banking dashboards and aggregators are trying to put together that more holistic picture for people. And hopefully, with the combination of greater control and greater financial understanding, this can really help people to make decisions that will help them build greater financial resilience in the long term. So that said, we are only just starting on this journey, and given where we are today, we know there's, with financial resilience where it is at, we know that there is a lot of opportunity still to help people engage with their finances for the better, particularly in really challenging times. So where do we see those opportunities? The first thing that we see emerging is really an opportunity for better service integration and holistic financial planning for people. So at the moment, there are a lot of services being delivered separately via different platforms, applications, etc. And actually really bringing those things together in a way that allows the customer to have a short, medium, and long-term plan to grow their wealth across all of these different formats. So budgeting, emergency funds, investing, retirement, etc., will really help, particularly as finances get more constrained, will help people to make sure that they're thinking about all those different timeframes and goals and balance their current needs and their future savings priorities. The second area is hyper-personalization. So up to this point, a lot of focus has been put on diagnostics, and we're now at a place where we can actually try to contextualize that information better and help customers build a personalized plan and then also stick to it. So, for example, we can use data, again, gathered across a really broad consumer base, to build more intelligent guidance tailored to the individual, their circumstances, their goals, that helps them understand what they should do next from a financial resilience or outcome point of view, based on their financial capacity, their habits. And then we can deploy a system of nudges, as mentioned before, to support and reinforce those habits and help that individual customer achieve their goals and track progress against their plan. And finally, we are seeing, I think, we know that fintech still holds a relatively small percentage of the overall market in comparison with legacy institutions. But we are seeing increasing amounts of knowledge sharing and collaboration and of course in some cases consolidation between fintechs and legacy providers, but also increasing collaboration between fintech, government and regulators, where we believe that there are clear opportunities to bring innovative thinking, to bring new forms of technology to help solve more legacy problems. And we think that initiatives like the Pension Dashboard Program, where some fintech capabilities are being used to try to address a known legacy problem, can be very successful, but they need to be delivered, prioritized, supported, and then delivered well and in the right way. So, I think in conclusion, the cost of living crisis has really been a wake-up call for a lot of us, and we know that the next few years are going to be really challenging for a lot of people. But fintechs, financial advisors, banks, and many others have the knowledge and capabilities to help customers through what is coming next. And the onus is really on all of us collectively to use the tools at our disposal, many of which are increasingly being delivered through technology, to get that information into the hands of customers who are going to need it over the coming years, and to therefore help build more financially resilient individual households, but also a more financially resilient nation. Thanks.
Thank you very much, Caroline. There are occasions when things fit together so nicely, you could almost believe that this was deliberate. Our last speaker in this session is Marika Lomas, who's Head of Payments and Fraud at Clio, who will be talking about how the cost of living crisis will change what most of you do. So, Marika.
Good morning, everyone. I'm sorry this wasn't planned, but this goes really, really well with the themes that we've been talking about before. I'm going to talk to you about resilience. No, I'm kidding. I'm not going to define it again. But it is actually really to do with something that Jason mentioned about the third type of resilience that he said, financial resilience for you as a company, right? And he mentioned really well the fact that sometimes it makes us uncomfortable as fintech companies to talk about the fact that we need to make money to survive. And if you feel uncomfortable with that, I'm really sorry. I'm going to be talking about that for the next 15 to 20 minutes. But we're going to cover some trends about this cost of living crisis, some data around that. And we'll talk about some techniques of how you can build a more sustainable payment strategy to be able to sustain your company throughout it. But let me first start with introducing myself. I'm new to the Scottish fintech scene, and this is a way to also prepare you for what's coming. I'm an ex-consultant, so there's going to be a lot of slides and a lot of clicking. Worked with lots of big banks in the past, and I'm a data scientist by training, so you're also going to see a lot of data. But don't worry, I'll walk you through it. It'll be all right. But let's get started. I'm going to start off with some data about the economy. We all probably have seen this before, we know it, but it's really going to help me drive my point home. And as a data scientist, it is my sworn oath to start every presentation and end every presentation with a graph. So let's get started. Most of this data is about the United States. That's where most of Clio's customers are. That's what I'm most comfortable with. But I've verified every single trend I'm going to be talking about here is also reflected in the UK economy. So if you're new to data, if you see a graph and it's going up and to the right, it's typically a good graph. So this is an example of a good graph. This is the total income of people in the United States. It's going up and to the right. Great. People are earning more money. And the bottom line is what economists call the disposable income. So that's what you have left over after taxes are taken out. It's growing at a less bit of a slower angle, but it's still going up and to the right. That's great. Now, I lied before, not every graph is great if it's going to the right. This is a bad graph, right? This is all of the personal outlays of people, how much they're spending on housing, how much they're spending on bills or interest payments. And that's going up. And if you're kind of data-minded, you can see it's going up at a much steeper incline than the previous graph was. And this is due to inflation. Before I had a graph here that showed inflation, but I'm pretty sure we've all had that shoved down our throats a lot. Inflation is high, right? It's driving costs up. So if you do all of the additions and subtractions, you can kind of see that the economist-defined disposable income is going up. But what I think is the true disposable income of our customers and people around is actually going down, right? So after we've taken all of the payments, they paid all of their bills, their utilities, they have less money left over. And it's not only a US phenomenon, right? I just took a couple of screenshots of recent articles from The Guardian. We are all worried about it. We are all worried about the fact that we might not have enough to get through. We don't really know how much we can continue to save, and it's on the top of everyone's mind. So if you zoned out after the first graph, right, 3 things you need to remember. People are making more money. Unemployment rates are the lowest we've seen since like 60s and 70s, but that income is gone a lot quicker than before, leaving us with a lot less true disposable income. So what does that mean for you as a company that takes payments? And even if you don't take payments, that's all right. We will make this quite general, and I'll walk you through some traditional payment strategies, how we think about it. And first, what do I mean by payment? There's lots of different payments we can talk about, from like peer-to-peer or to the company. What I'm really talking about today are recurring payments, right? It's something that's coming from a customer to you as a company, and you are hoping that it will happen on a recurring basis. Caroline talked a lot about how companies are moving into like automated savings deposits, or into subscription services, or honestly at any sort of payment that you want somebody to make for your product on a recurring basis. So what do you need to do to make a payment happen, right? So your goal is to take a payment of X dollars. And I'm really sorry, I had it in pounds before, but I was practicing and I kept saying dollars, so we're gonna talk about dollars here. So you wanna take a payment, right, for some sort of product. What are the 3 things that you need to be true? 1, the person must have the funds, right? Simple. They must either have cash in the bank or access to some sort of line of credit to be able to pay for your product. 2, you need to be able to access that money. If they have that money in a bank account, but you don't have a card linked to it or a direct deposit set up, that's not gonna do you any good, right? You need to be able to get at the money. And 3, well, this is probably the most important one, the customer must actually want your product. They must see value in it. But given that I deal with payments and fraud, I'm just assuming that your product people have figured that out, so I'm not gonna talk about it. So let's really talk about the availability of funds, right? I just proved to you with nice graphs that it's going up. People are having more money and more income. So that's like the simplest way to think about it, right? If you want more people to have availability of funds, they will have more income. But what I think is actually more important here is the flow of funds and how long that income remains available in their bank account. So more graphs. This is a sample user's availability of funds, right? It shows how much money they have in their bank account. If you only think about the fact of like, okay, does my customer get paid on a regular basis? This looks like a really great customer. They get paid every single week from $500 to $1,000, so they should have enough funds. But if you were to try to take a payment from that at any random point along that timeline, you're more likely to fail than succeed because that money is immediately gone. It's maybe lasting there for 2 days, most likely just 1, and then it's immediately gone because they've spent it, they've moved it somewhere else. So that flow of funds is incredibly important to understand. Second bit, accessibility of funds, right? We can talk about like cards and direct debits and setup, but that's not fun. Let me talk about some trends that we've seen in the fintech industry, especially as we've seen the disruptors come on the market. Gone are the days of the family bank, right? Where like your mom and dad banked at the same bank, so they created you an account and you go there and you have your income and bills coming out of it. That's not really the trend anymore. People are going to new banks. They're putting their money into crypto wallets, sending them overseas, whatever you will, right? Their income's being distributed in different places, and that makes it really important for you to understand where you need to get access to be able to get at that income. The second one, and Jason actually talked about this, right? The ability to freeze your cards. So in the past, if you didn't want somebody to use your card to take a payment from it, you had to go through this whole process of reporting it as lost or stolen. That's no longer the case. A lot of banks are now allowing you to just freeze your card, and no merchant can get at the funds there, which I'm not throwing shade at it. I think it's a wonderful feature. But if you're trying to take payments, this is going to affect you, and you need to think about it. And finally, disputes and chargebacks. This has always been the case. They've always been around, but they are way more accessible than they ever were before. You can just click a button and dispute a payment that you have successfully taken. So again, this is going to impact your access to funds. And taking these two ideas, right, your availability of funds and your accessibility of funds, we can map out all of our customers into a graph of where they lie. And for every company, this is going to look different, right? You might have a lot of customers that have a lot of money and then they're constantly accessible, and that's great. Or you might not. For example, Clio, most of our customers are in the low availability of funds area with different levels of accessibility. Let me take a step back here and talk about payment strategy, and then I'll tie it all together at the end. There's 3 different ways that usually most companies take payments. So the goal is that you have a payment that you want to take, and it's due on a specific date. The most easy way to think about it, this is something that like Netflix does, right? You try to take a payment on that date. If it succeeds, great. If it doesn't, well, then you just make it up for, like, it's a customer's responsibility to fix it, right? They want to watch Stranger Things, well, they got to come and pay for it if they want to continue to watch Stranger Things. And this is highly reliant on customer motivation. How much do they value your product? If they don't value it, you're not going to get that payment. And that's why many other companies then continue to try again, right? It failed once, we'll let the user know, but then after a certain amount of time, we'll try again and again and again until we decide, like, okay, we're going to give up on this user. We're just not going to get that payment. And then if you're into lending, you might then get a third party involved, or you have your own collections company, right? But you're going to continue to try to take that payment back. And this works great if you have somebody that just has funds that are easily accessible, right, at all times. But it's going to get a lot harder when you have people that might not have the cash, or that money might be somewhere kind of hidden away. And maybe you're like, oh, that's fine. Like, most of my customers are in the green segment, so this isn't really relevant for me. But this is where the economy comes in, right? So we already talked about the availability of funds and how that's going down. Let's talk about the accessibility of funds. I had a hard time finding like publicly available data on this, so I went into Clio, and I chose a bank that I know gives you the option to toggle the freeze my payments option. And I looked at the share of payments that have failed because a user has turned on that function. And this has always been available. Back in like the January 2021, people weren't really using it, but something's happened. And I don't know if this is because they updated their app and it's now super prevalent and people can click it, or if it's driven by users' needs. But a lot more people are stopping, not just from Clio, right? Any merchant from being able to take payments from their card because they want to control who's taking payments when. And the second bit is around disputes and cashback. I think if you work in the fraud space, you'll see that disputes are going up. They have been going up since the pandemic, and they're going to continue to go up. That's my prediction of the future. It might be wrong or not, but if you go on the website and you Google how to deal with like the cost of living crisis, how do you have more money if you don't have it, then one of the #1 tips is go and dispute everything and see what sticks. So we are going to see disputes and chargebacks continuing to go up. So what does that mean, right? We'll go back into our graph. So even if your customers are in that top right segment, well, that's great, but they are no longer going to be there. That segment is going to shrink. It's probably already shrinking, so you're going to have to figure out how do you continue to take payments from it, and what tools do you use to do so. And not to be scary, but like, happy Stormtrooper, there are ways to deal with this. And the #1 thing is, and I know KYC is like the most scary term, so I'm not saying know your customer, understand your customer, and really understand the finances of your customer. I think Caroline put it really well about this hyper-personalization. You need to figure out what works for whom and how. And there's a lot of different ways that you can deal this strategy, but I'm going to talk about specifically when they get paid and what their flow of funds is like. So let's take a step back to the traditional way of taking a payment, and I'll take a sample use case here. So someone's payments to you, you tried, that failed. You tried 3 more times, it failed. You never got the money. That sucks. Let's say that you figured out when that user is going to get paid, and it was the day after you stopped trying, right? So had you known when they're getting paid, you could have known that, oh, if I tried 1 more time, I would have been able to take revenue. Like, I've gotten revenue from this user. And it's not only about getting revenue, it's also about your gross margins, because every single time you tried to take a payment, you incurred a failed payment cost, right? This user was really, really difficult to take payment from and costly to you as a company. So there is benefits for you as a company, right, in terms of your revenue and your gross margin. But there's also benefits to the customer. And this is where the concept of ethics comes in. It actually helps the customer when you think about their financial situation before you try to take payments from them. At any point where there was like red failed payment costs and try agains happened, you could have put that user into overdraft. They could have gotten an overdraft fee. And that's something that we know is a big issue. It's not only a US problem. I know a lot of people in the US talk about this in terms of the big banks and the fees that they charge. It's like $250 per year per person that they pay in fees. It's absurd. But it's an issue here too, right? We have almost £4 billion in overdraft from customers. So one of the things that Clio's done is that we actually made a promise to our customers that if we put you into overdraft and you incur a fee, we will pay that fee. We will pay that interest, because that's not what we want to do. And that's what I encourage everybody to do it. If you can wait to take a payment, wait. It helps the customer. And it actually helps you as well. This is something that surprised a lot of people I've shown it to. If you've never gotten an overdraft charge, which I'm guessing here it's not in the US, but this is what it looks like to the person. It's not just the bank saying, hey, I took X amount in fees. They tell you why they took it. So think about that middle scenario. Somebody set up automated savings deposits, every week $10 into their Albert savings account. Well, one week they messed up and they didn't have the funds. So the bank charged them $35 in fees, and they told them why they charged those fees. And the person's not going to think, oh, I really hate my bank, I should go away. No, they're going to think, I'm not ready to save yet. I'm going to turn off that savings deposit into Albert. So it doesn't behoove the bank, it behooves the merchant. And one of the things we realized is when we got better about taking payments at the time that the user was getting paid, we didn't make much of a difference in terms of how much they were charged in overdraft fees, right? Because we were a small drop in the ocean, they were going to be charged by any banks anyway. But we reduced our cancellations by 6%. We weren't even trying to do it, right? But just because we got better and we worked with the customer and their flows, we reduced our cancellations. And I know percentages, people don't really like it because, like, what does that even mean? But if you were Netflix, right, that would have been millions of customers that you could have kept at the end of the year by reducing your cancellations. And so let's say that you figured out when people are getting paid. Great. You know exactly when their income's coming in. It might not be enough. So let's say we figured out that somebody's getting paid on September 1st. And at 1 p.m., their income is coming in. It stays there for about 10 hours, and all of their bills come in, and then they lost their money by September 2nd, right? Well, not lost their money, but it's below the threshold of those X dollars that you want to take. So this is an example of how Clio's payment strategy used to be. We used to do it every single morning at 9 a.m. We would be like, okay, let's figure out everybody that owes us money and try to take that at 9 a.m. Well, on September 1st, we're like, we know they're getting paid today, so let's try it. And it failed. We came in too early. And then we're like, okay, September 2nd, let's try it. And we failed because we now took it too late. And one of the reasons is because we didn't think to understand the fact that in the United States, your direct deposit usually comes in at 8 a.m. Eastern time, which is 1 p.m. here at British time. So we needed to change our strategy to really think about the flow of funds and think about when we can take a payment. And my last slide, I promised I'd end with a graph, but this strategy has really worked for Clio. We started working on this around this time last year, really thinking about working with the customer, and we've been able to improve our ability to take payments by nearly 30%. And if we were, again, Netflix, that would have been $8 billion of additional annual revenue that we're taking because we're working with the customer and not just trying to take payments whenever we can. I hope you learned something about payment strategy if you didn't like it, but thank you for your time.
Okay, there's a chance to ask questions of our three first speakers now. We've got a couple of live mics in the hall. If you have a question, if you can stick your hand up, please. We'll get the microphone to you. Identify yourself. First, say, I am, and then ask your question, please, once I've sort of pointed to you in the first place. Questions can also be asked via Slido if you just scan the QR or enter the code. Okay, that's another way of doing it if you don't fancy speaking. Now, nobody ever wants to ask the first question, but somebody has to ask the first question. So, who has the first question? Listen, I can stay here all day. I don't care. Thank you very much.
Hi there, this is for Cleo. I'm sorry, I didn't catch your name. You mentioned a really interesting thing about optimizing when you take payments. I completely agree with all of that sentiment. But I wonder, how do you know when to take payment when you don't have any insight into who else is trying to take payments? i.e., is there a need for real-time data sharing across all of the, I don't know, lenders, recurring revenue businesses? Yeah, great to get your thoughts. Thanks.
Yeah, I think it's a really good question. I was expecting that, so thank you. It really depends on like how much information you have. You're right? So some people like Cleo, for example, we use OpenAPI. We know when people are getting paid, so it can be quite easy for us to figure out, okay, this is when they have funds and when they don't. But we also have users where we see nothing, and the sad answer is that you will not know for sure. You have to figure it out. And there's a lot of really great machine learning techniques, and I'm happy to talk about it later as well. But you have to get a bit wild with taking payments and understanding your customers, see what works and what doesn't, and really trying to predict like what's their income schedule like. And knowing your customers, right, if they're in the United States, they're mostly bi-weekly. If they're in Europe, they're mostly monthly. So if you know that you were able to take a payment from them the month before, you can then ascertain that you might be able to do so a month after as well, right? So it's all about trial and error and trying to build models and internal knowledge to do that. But I think, of course, there is potentially some third-party integrations you could use as well, but we can talk about that more in detail.
What I found fascinating about your presentation is how clearly it illustrates how close to the edge some people are living, but also, by extension, how close to the edge some companies must be living at the same time. And have you any thoughts on that, Jason?
Yeah, no, I completely agree. I think that it was a great presentation to follow on from the comment the sentiment I really expressed, to be honest about how you are making money. And I think that there is a definite the gentleman's question, you know, how do you know that you're not going to be taking a payment at the same time as everyone else? And you don't. But if you could know, then there's the inevitable clash, right? If the customer has £20 in their account and there are 3 payments of £10 coming out, who gets to go first, right? And I think this really has to be that we have to use all the technology we have to have a negotiation between the people wanting to take the payment, the banks holding the money, and the customers whose money it is, to try and work out, well, we've only got £20, which of those, you know, payments should we make, or does the customer want to go into debt to make all of them? And I think that the more technology we have, the closer we can get to actually being able to do that.
Caroline?
Yeah, I think that, you know, as
I'm getting to lean into the mic.
Oh, sorry. Apologies. Yes, I mean, I think obviously the companies that are trying to make revenue on the basis of customer transactions, right, you know, that they are therefore very much subject to how those transactions are progressing. And I think we've seen with you know, a number of companies recently that the ability to take payments or the ability to monitor those transactions effectively is having a real impact on their top and bottom lines right now. But I think that what's beautiful about the example that was given is that, you know, how can we find better ways, in the spirit of building consumer resilience as well, for those two things to work collaboratively together by using better data models, et cetera, so that the customer doesn't suffer and the business can still collect its revenue to be able to continue to operate, as Jason was saying.
In the old days, Marika, people used to sort of bounce debt from one credit card to the next and what have you. And it got tremendously labyrinthine sometimes. Are you suggesting that this self-blocking capacity on app is being used in a different way? It's saying, look, I'm sorry, I've only got 400 quid this month, so that's dealt with, and I'm not taking anything more off my account from now on because I simply don't have it. Are people using it that way?
They are, yeah, and that's more that we're seeing it, right? And it's great because they have that control because they can stop themselves from going into debt. So I do think ultimately it's the right thing.
But they are going into debt because, you know, there's somebody looking for a payment further down the line, and they can't get it because they've closed the card down.
Yeah, I mean, that is true, right? And that is putting the responsibility back onto the merchants, back onto the companies, back onto us to figure out, okay, should we have a relationship with this customer? Are they going to be able to pay for it? And it's like an interesting bit. I think it's also Caroline as well, of like, is this product the right product for our customers? Should we be personalizing it more based on their true financial situation? A lot of times it's like, okay, if you are unable to do it because they block the ability to do so, should you have had that relationship with that customer to begin with in that way that it was set up? And that's a question we're going to have to ask ourselves.
I think one really interesting thing that I've learned today is that is about using the card freeze feature to stop payments. Like when stop payments that you set up, because when Starling and others created this card freeze feature in the first place, the reason we created it was for security purposes. It was you think you've lost your card, but you don't know, and you don't want to cancel it, then find it immediately down the back of the sofa. So instead, you freeze it while you look for it. But then, obviously, if you give customers control, they will find ways to use your features that you didn't intend. And, that has to be taken into account. What I'm keen not to see is the working out when customers have funds and taking funds from them. It doesn't become a cat and mouse game where the customers work out that you're using this feature, then try to outwit you, and so on and so on. And there has to be a way for everyone to reach agreement about where the money should go.
Take a couple of questions off Slido. That first one from Jasneed. Do you think the credit card debt culture, which allowed banks to earn more money and boost the economy, is responsible for people not having savings today? Caroline? Lucky.
Oh, I know. It's. I think that I will not profess to be an expert on credit cards. I think that what we've seen from some of the things I spoke about poor financial education, right, is that if people do not understand the problem with credit card debt, right, is that someone might start with relatively low balances, but then very high interest rates exacerbate the problem if they're not able to pay off that debt very quickly, right? And yes, the banks certainly profited from this, and I know in the United States, credit cards were given out very easily to people. And so I think that it still is fundamentally about, how do you help people understand the decisions they're making and the debt they are getting into, and how can you help them have a plan to get out of that? And we are, obviously there are many services around trying to help people manage their debt now, but it remains a problem. And obviously in the current climate with the cost of living challenge, people are going to be resorting to credit when they can't afford things.
More or less at the top of your presentation, you pointed out that, in terms of how much cash people had sitting around, how long they could last just off their savings. 2014, it was 7 days. 2020, it had gone to 24 days.
The data's not exactly, so the first statistic is around, so a third of UK households could not have lasted for a week, whereas the second figure is the average across UK households. So it's, we did some research recently that pointed to a similar, maybe even slightly higher number on the sort of weekly. Yeah, it was a third of UK households wouldn't be able to have a month's savings at the moment, which suggests there may have been some progress. But I think that when you look at the comparable data of 2020 to 2022, it's very obvious that resilience or rainy day funds have gone down by 20%. During this period, right? And we saw people's incomes squeezed very hard in 2020, some recovery, I think, for a short period, and now they're getting squeezed again by inflation.
Just in terms of the sort of democratization of access to the kind of advice that, previously was the sort of reserve of wealthy people, how do we ensure, says Anonymous, that people on the lower income, lower digital literacy with less resilience get support to plan for the future? Is it the government? Well, I would add to this. Is it the government, the industry's responsibility, or is it the individual's responsibility?
Yes.
Moving on.
I think it has to be a collaborative effort, right? I think that the problem with just pushing it onto one of these groups is that group will take a particular view, but really this involves all of those. This involves financial regulators, it involves the industry, it involves consumers, trying to make sure that we bring up the rate of digital literacy, as well as the ability to the resilience of individual finances to be able to weather the storm. And I think there has been a lot around that. A lot of it is about fairness. It's about banks and other financial organisations treating customers fairly and making sure that if they're going into debt, they really do know they're going into debt and they have an understanding of what that means, the implications of that they can have the ability to pay that debt back, and they're not going to get trapped. And that's really what requires, I think, all three of those to work in concert to achieve that.
Marika?
Yeah, I think personally speaking, the company I work with, that's what we do, right? It's all about financial education. So I absolutely agree that it's all three. It's the government's responsibility to kind of give the tools and the access to find it. But people, as we found out, don't tend to go to your government websites and be like, how do I, reduce my credit card debt, right? It's not really going to happen. So it's like, how do you get it in front of them? How do we tie it into the decisions that we're making? And I think there's really cushion on the NPL as well, about like buy now, pay later, right? Like, is it the job of others to warn people about the dangers, or is it their job as the company to educate their customers as well? And I do think it's a mixture of both.
That last question on the screen at the moment, about pensions and the lack of customer knowledge, contributions to the future, do you see fintech being the new gateway to changing this? It's not just a potential disaster for the individual. It is a national potential disaster, because you can end up with millions of people, theoretically, who simply cannot afford to live. And then what does the country do?
It's a huge, huge problem. And I think that, I think fintech, as I expressed, I think fintech can do a lot. I mean, the fact that, we sort of say it's in your pocket, like people are no longer getting their annual pension statement. I can pull up my pension on my phone and look at it, right? And I can see projection graphs that show me that if I add another £50 a week, here's where I could end up in the future. And I think, that transparency should be really empowering for customers, in the sense that they can see what they can do that makes a material impact on their future. Now, obviously, it also has challenges in the sense that it could be tough for people to see that at their current savings rate, they're not getting to where they want to be. And so how do we provide better tools to help people still save well for the long term? But I think that it's not just fintech that's the solution here as well. We can try to do a lot, but the vast majority of pension funds are still sitting with legacy providers, and they also have an obligation to try to help people make good decisions. And they have the customer, so they have the ability to speak to them.
But it doesn't matter how well you educate people. If they need the money this month, they cannot afford to save. It doesn't matter how much you say, well, it'd be a very good idea if you did.
And there's an interesting case we've seen as well. It's like the more financially struggling people are, they're less likely they're willing to look at their finances and use these apps to help themselves, right? We did a feature of our shows, your projections, right, of your income. And the lower that was, actually, the less people looked at those screens, the less they were willing to engage, because often you get into a state where you're in a dire situation and you're just kind of like, like things are fine, like I will make it through. And so I think that's probably where kind of this public education comes in, right? How do we make people aware that these finance apps are there? How do we make it accessible in a non-blame culture, right? Of like, okay, you're in this situation, here's what we can do to help out. And I think that's probably where the government's role is a partly into it. But again, people must ask for that help to find it. So how do we make them aware that this help is out there?
Yeah.
I think people also, just sort of adding on to one thing, people also have a tendency to, and it's different when someone's really just at the line of, can I afford to buy groceries today? Right? That's a totally different question. But there's also something where people tend to approach big financial goals one at a time. I think cognitively it's easier, right? I'm going to save to buy a house, period. I am going to save for my children's education, period. I am going to save for retirement, period. And I think one thing that we can try to do is to bring more of those goals together and to show that, if you can manage to find even £20 to put aside in a week, what proportion should be going to those different goals, and how can you actually try to balance the long-term impact, right? Because as I mentioned, if you save for a house for 10 or 15 years, maybe, right, then actually you're missing out on 15 years of compounding returns in your pension, which actually in time will add up to far more. And so how can we better help customers make those decisions and trade-offs by providing them tools to really understand that impact?
Question from Ryan there at the bottom. Several of the presenters indicate that making money was almost frowned upon. I can't remember which politician said that the other day. You know, sort of, profit is not a dirty word. Well, it depends where you are on the scale. How do you balance shareholder interests with your social responsibilities?
Yeah, I think that you have to. The problem comes when you try and emphasise one of those over the other.
But it's a legal requirement. If you take the energy companies, for example, the directors of energy companies are duty-bound, legally bound, to do the very best they can for shareholders.
Indeed. So I can't speak to the regulation of energy companies, but I can speak to the regulation of banks.
Yeah.
Banks are, duty-bound to think about their shareholders. And they're duty-bound to treat customers fairly.
Is it a legal requirement?
Yeah. I mean, it's the exact difference. I'm gonna jump in on the lawyer's answer. It depends. But there's definitely, if we stop ignoring regulatory requirements, then our banking license gets taken away, and that's game over. So it's as good as. So we have to concentrate on both of these things at once. And ultimately, shareholders aren't going to be benefited if you start ignoring your customers, get a reputation as someone who ignores your customers, and then lose all your business. A lot of the problem, I think, comes over what period of time are you concentrating about your shareholders' returns on. If you're concentrating on, get the quarterly statement out every quarter, things have to go up, things have to be rosy, and so on, then you're going to get into trouble. You have to be thinking about your shareholders, I think, and taking your duty towards them over the long term, and over the, can we get a stable business going, a stable revenue stream for these shareholders over the long term? That's the important question, rather than the quarterly statements.
I would be interested in getting Caroline or Mariko's thoughts on this. How would you incentivize companies to do just that, to think in the long term?
Well, what I can say at the moment is that we are still a privately held company, right? And I think having the right investors, which I'm sure is also something that's on many people's minds, who may be founders and so forth here, is having the right investors who understand the value proposition you're trying to deliver to customers and the time frame in which you intend to deliver it is really, really important. And that changes when you're a publicly listed company, for sure. But I think that having investors who are aligned to a long-term view and see how doing well by your customers in the long term, at least in our sector, right? How doing well by your customers in the long term will turn into good results is really critical.
Because if you don't do right by your customers, you're going to stop existing as a company, right? That's the real long-term vision. If everybody tries to squeeze the last cent out of everybody, there will no longer be cents to squeeze at the end of it. So I think, to your point of how do you get people to think about the long term? I mean, you have to think about the long term for your company to survive, and sometimes you have to make those considerations, like the question right about ESG, right? Like your actual societal responsibilities to your customers. If you don't do that, you're going to lose them.
Now, I'm just wondering, I can absolutely see the logic of thinking long term. However, it's annual returns that actually dictate how much bonus the chief executive is going to get, for example. So what I'm wondering is there a method of saying, tell you what, look at it across 10 years or 5 years or whatever, and that ties that one person, that particular thing. So it is not entirely straightforward. It is problematic.
Yeah, I'd say the easy answer to that is stop paying your chief executive a bonus based on annual results. I think that, the incentives drive behaviour, and if you incentivize particular behaviours that are short-term, you will get short-term results, short-term success, but not long-term success. So, I think we all want to build a long-term, sustainable, viable business, and the way to do that is to encourage everyone working at the business to do that.
There was a question on the screen earlier, it's disappeared, but basically it said, are people becoming more tolerant of basically just writing off debt? So that, well, I'm sorry, I've paid what I can't pay any more. Are you seeing that as a phenomenon?
Oh, yes. We've gotten a lot of not complaints, but people saying like, hey, so we do like advance lending, right? So we do pay, essentially allow you to give an interest-free loan, right? That you have to pay back after you get paid, right? But just to get you through and not go into overdraft. And the volume of people writing in being like, I'm declaring bankruptcy, like this is it, you're not going to see this money again. It is growing, and it's growing at a quite a stark rate.
What can be done about that? I mean, there's a limit to how much people can actually tighten their belts.
Agreed, and that's why we have to figure out how do we work with them, right? There is something about coming from a place of empathy, of like we understand it, but at the same time we are a business and we need to survive. So we need to put in the tools to really understand what we can do. And then sometimes it is to take a step back, being like, okay, well, we can't take the full payment. How much can you pay, right? What is the solution that works for you? Can we put out different tiers of subscription services, different tiers of product services that can actually work for people? It is a question about personalization because our customers' states and their financial situations are changing. So we need to change with them to be able to do so. But there is going to be a question of, is there going to be a time of write-offs? About cases where we just really can't do anything because we cannot magic people to have more money.
Question right at the very back there, please. So, thanks, Pete. If you could identify yourself, please.
Hi, my name is Puneet, and this is a personal question. I have an 11-year-old girl, and the extent of the financial education that I have with her is we have Money Mondays, and we watch a Rich Dad, Poor Dad video, and I try to draw out lessons from that for her. So do you have any recommendations, any other suggestions that I can be doing with her? She's 11, so she grows up financially savvy.
Who would like to take that first?
Sorry, I couldn't hear it very
Yeah.
Right, okay. I'm terribly sorry, none of us at the table could actually hear what you were saying. Pete, would you mind actually just, or say it again, sir, just do it very, very slowly and very clearly into the microphone.
Right, sure, once again. I have a 11-year-old daughter, and every Monday, so we have Money Mondays. Every Monday, we pull up a YouTube video by Rich Dad, we watch it, and then I try to draw the lessons out for her. That's the extent of the financial education I'm doing with Ela. So I wonder, are there any other recommendations from the panel which I could do right now so she grows up financially savvy?
I wish my 26-year-old daughter would do it. No, my man. Yeah, fine. Right, you got that. So basically, every week, listens to a YouTube video, tries to draw the lessons from it, etc., as a form of financial education. Where else can the gentleman go?
So, I mean, that's amazing. Well done. I think you're very far ahead of the vast majority of people if you're trying to engage your 11-year-old on that in the first place. There are a number of apps and banking tools. The ones that come to mind quickly are things like Rooster Money or GoHenry that are designed to try to use real-world scenarios to try to get kids to think more actively about money. So you can give them sort of prepaid debit cards, and you can control how much money goes on and off them, and then you can kind of give them the responsibility to actually go out and manage it themselves. So I think that sharing thinking with them, showing them videos is great. It's a phenomenal start. But I think actually also giving them a little bit of room to like experiment with some real-world things and see what happens. You could even go so far as to buy them a share of stock and like let them track it and see what it does. I think there are so many ways in which just if they can actually see it play out and how it affects their real life. If they save their money every week, their allowance or whatever, and then they can save up to buy the thing they want. They start to learn about budgeting and how to make those decisions for themselves, which is really important.
I agree with everything Caroline said, but use Kite by Starling.
Okay, sorry.
In your unbiased opinion, yes. Marika.
I love that. No, I mean, that's exactly it, right? I think it's through practice. Like, it's that old experiment where we give kids, You can have one marshmallow now, or you can have two if you wait an hour, right? Like if you think about the concept of, how do you teach an 11-year-old about like compounding interest of like, okay, you can go and buy this candy now, or if you don't, I'll give you some more money if you put it into a savings account, right? I think those practical examples putting into practice, that's exactly the right way to go about it.
There was a point you made, Caroline, too, that people sometimes are more comfortable with tech because they see it as being more neutral. If it's coming from even if it's aimed at children, if it's coming from a bank, you think, yeah, but you're going to direct the kids back to the bank. It's try and tie them in early.
Yeah, I mean, I think there is a way in which people think that sort of algorithms are neutral, right? Like the algorithm doesn't know who I am. It's just operating on the information that I give it. Now, there is some truth to that. There is also some truth that algorithms are written by humans and they have biases in them. But I think for a lot of people, it gives them comfort to think that this is just, like whatever I tell it, information that I can control, it will give me a sort of honest answer back.
Which is not correct.
Well, it's, there's a lot of, and I'm sure you, from a machine learning perspective, a lot of algorithms are built on using extrapolated data sets. And if the data sets themselves are biased, which they often are, because they are heavily skewed towards particular populations or et cetera, then of course the algorithm and the machine learning can only learn from what's being put into it, and it will actually have a bias. But that said, I think in the context where I've seen it play out, which is in sort of, not with Moneybox, but in more generally in the robo-advisory space, right, it is a relatively limited set of inputs that actually should deliver a relatively neutral outcome, but still we have programmed that algorithm based on our perceptions of risk, et cetera, et cetera. Yeah,
the algorithm, the machine will always give an honest answer, even if it's not one you want to hear. It has, that's one reason I think that people regard them as more neutral, is that the machine won't try and sugarcoat anything, or, won't use, are you particularly sensitive today? Maybe I won't tell you this. It'll just come out and straight tell you, oh, you're going into debt now, and nod, and it will say that with exactly the same, tone as it would if, it said you just earned £50.
Yeah. Interesting. We've only managed to get through, I think, of about a third of the questions that came up on Slido. So my apologies if your question was not asked. But can I ask you to show your appreciation to our three speakers one more time, please? Thank you.